Okay, wow. Jerome Powell today was like a dad who's mad at you for having kicked somebody's butt, and he's yelling at you. He's like, "How dare you kick that kid's ass? How dare you do that?" But he's got this little smirk on his face. He's kind of like, "How dare you?" because he's kind of proud of you. And in this case, the fight is CPI. It's like, yeah, CPI is coming down. Kick its butt, right? Kick it down. And he's kind of like proud. He's like, yeah, that's my son, right? But he's also like stern, like, but don't do it again. Like, don't mess up CPI. You know, it's like that's what it felt like today. Like today, honestly, it didn't really feel extremely like hawkish or extremely dovish. We kind of got a hawkish SEP report that initially led to some selling off. But he was kind of, honestly, that stern dad that's like, don't do it again, but good job. You know, that's kind of like the best summary, honestly, I have for this is that, like the proud dad. Like the proud dad that you would have if you signed up for the programs on Building Your Wealth using that coupon code expiring today, PAPE, so you can join the trading alerts in the stocks and psychology of money group or learn 0 to millionaire real estate investing. By the way, I really think everybody watching can become a millionaire in real estate. It's kind of easy. Okay, anyway, let's get into the Fed. So the way I wanted to break this up today is I want you to think bad, neutral, good. I think that's the easiest way to break this up. So let's start with bad. Okay, bad was what we got in the report. I did not get a lot right in my projection, which is fine because as we talked about in the live, the reason you make projections is to see where you don't align. If you don't make any projections, you can't adjust your feelings in any way, right? So we had initially a bad SEP because this came in way higher than the market was expecting and what I was expecting. In fact, the Fed's dot plot, I personally projected that most of them would come in under 5% for the terminal rate. That's not what we got here. Most of them were right here in that 5 to 5.25% range, 5.5% range. That's where the bulk was. So we started with bad news. You know, our number one piece of bad news is we moved the terminal rate to 5.1%, and the Fed's had a tendency of moving these up. That's not that great. The range was 5.1 to 5.4%. Not that great. That was bad news. GDP moving up in 2022 to 0.5, big deal. Massive revision down over here in 2023. That's potentially recessionary. We could have a Q1, Q2 recession, or potentially a Q1, Q2 positive economic growth, but then a Q3, Q4 recession, and you could still end up with an average of 0.5, but have a recession within the year, right? Because you only need 2 quarters, whereas you need 4 to create that number. Unemployment rate projecting going up to 4.6. Jerome Powell says this is still low, so it's fine. This is probably the least important projection, their inflation projection. It doesn't matter so much. But this SEP was aggressive. That's just the way to put it. It was aggressive. This was Daddy Powell going, hey, don't do it again. Stay the course. Get inflation down. This was the Daddy Powell, right? But that you know, he had some other bad things to say, which we'll talk about those. But the good part was that he's proud about inflation coming down. But we're going to talk more about that in a moment. I want to stay bad, neutral, good. So sticking to the bad, we're going to stay restricted for some time. We caution against premature loosening. This is old news. We've heard that a million times before. No rate cuts projected in 2023 by the Federal Reserve. Now, they're just saying that. The market doesn't believe them as far as the market can throw Daddy Powell. They don't believe it. You know how the market doesn't believe it? Bond yields at the time of this recording after the meeting went down. Look at this. The Fed talked dirty to us about how they're going to raise rates higher than anticipated, higher than what the market was pricing in for the terminal rate, and told us they were not going to cut rates in 2023. And the market said, whatever, old man, rates down. Okay, that's another way of saying that the market doesn't believe the Fed. The market actually thinks the Fed is going to get the inflation reduction that we're on the trend for now, and they're going to end up cutting rates. Now, Jerome Powell gave us the recipe for when he's going to cut rates. We'll talk about that in just a moment. It's not a terrible surprise, but I have a formula for it that I'm going to share with you, my opinion. Okay, so this uniformity by the Fed around that 5% on the dot plot, unexpected. That was bearish. Middle of the next year, they're expecting to see slowing inflation come in from housing inflation, which is really good because if you think about it, if we're on slowing inflation now Imagine how much inflation is going to drop when that rental inflation from that stupid lagging owner's equivalent rent, which lags like 6 months, comes in. You're going to see inflation just gap down, like after hours gap down, as they say. Anyway, so some beginning signs of inflation starting to rotate down in the labor services sector, which is really good. You got 45% in PCE that comes from housing services, 55% that comes from other labor services. That other labor services side is starting to see some softness, and that's good. That's the third part of inflation coming down: goods, housing, labor. Starting to see that rotation coming down in labor. Jerome acknowledges that. However, he also says we need to see that consistency. He does believe that eventually the labor market will soften, and that will create some pain. But he kind of says, sorry, it's just doing my job. Got to do it. Sorry, some people are going to lose their jobs. He kind of admits to that, right? And okay, I get it. I mean, he's being blunt about it, basically. So on the neutral side, he kind of dodged a question about stagflation. It doesn't seem like stagflation or recessions are really scenarios that they're really thinking about right now. They haven't talked about what kind of recession scenario would be, something that they would react to. So Jerome Powell did not give us really any insight into stagflation or recession. They're not expecting that. Now, they've been wrong pretty much on every projection they've made. So, if you were to kind of lean towards the more hawkish side, that would be reasonable based on the trend. But maybe we're at a U-turn now. Who knows? Okay, so let's talk a little bit more about the good. This was the interesting part for me. Because of this new SEP, 5-year break-evens fell. That's good. 5-year break-even is, it has to do with the spread between Treasury inflation-protected securities and non-inflation-protected securities. Basically, it's the market's way of telling you, what do we think inflation's going to do? And, sir, we think it's going to go down. In fact, these inflation expectations are at some of the lowest levels that we have seen all year. They've only been lower once before this year, and that was at the end of September when we had a nice little rally, which was cool. But otherwise, we're at the lowest levels we've been at for inflation break-evens all year. And the consumer sentiment surveys have been coming in lower, so this is great. This is great. Somebody here just donated to CHF. I don't even know what that is. It's probably like 2 pennies. In fact, actually, I probably have more money right here in my hand, which is 2 pennies. But I appreciate this too anyway. Bonds see more deflation. I agree with you. I agree that bonds see more deflation. But you put a little bear. I don't know why that would be bearish. It seems bullish to me. But thank you for the 2 whatever. Appreciate it. All right. So okay. Now, my expectation on this sort of formula of when are we going to see actually like rate cuts, I think the Fed's going to make us wait until we get 5 sustained CPI reports. That's because even though Jerome Powell applauded the 2 very good reports that we just had on inflation, he said, hey, those 2 reports just reiterate what we think is going to happen, which is inflation is going to go down. But we really need to be confident that inflation is on its way to 2%. So I think 2 reports is the start. I think you get 3 more reports. That's 5 good CPI reports in total. And guess what you get? I think that's when you get the Fed U-turn. Now, my guess at this point, let me show you on the calendar what that looks like, okay? So I think I would write this one down, okay? This is something I would write down. We just had the 50 basis point. Everyone and their granny knew we were going to get 50 basis points today. We have 1 CPI report between now and the February report, which could be a 25 basis point hike, could be a 50 basis point hike. Jerome Powell gave us no clues at all. I don't think it's going to be 0 because we're at 4.25. They think the terminal rate is going to end up being 5.1. Why would we get a 25 in Feb? It'd be nice. I don't think it's too likely. But we do get 1 CPI report between now and then. Maybe that 3rd CPI report suggests they go to 25. Maybe. We'll see. March 22nd, we'll have 3 CPI reports. So if we have all 3 of those CPI reports, Jan, Feb, and March, whereas over here in Feb, you'll only have the January report, right? If we get all 3 of those reports that come in low, what happens? All 3 of those reports come in low. That's when I think potentially the Fed says we're going to cut in May. Rather than doing 25, 25, 25 continuously, they might cut in the next meeting thereafter. Because then they'll have 5 reports in a row. In fact, they'll even have more by the time May comes around. They'll have another 4 or 5 in total from now, which is kind of incredible. So Yeah, end of Q1, beginning of Q2 seems to probably be the earliest potential for a rate cut, though Jerome Powell made it very clear, don't expect rate cuts. But he has to say that, you know, if he's like, hey, yeah, maybe we'll do some rate cuts, dude, everything's going to unwind. The stocks are going to rally and you know, all their work kind of will start getting undone before we actually get those reports. So that said, you know, markets are slightly down, a little bit flat right now in reaction to this. Again, I think this was mostly an uneventful Fed meeting, but it certainly was one that gave us a little bit of welcome news, and that was actually Jerome Powell saying, "Hey, you know what? We're in a position where we're doing good. We've got 2 great reports. Let's stay on that course." Now, I think we have a lack of catalysts between now and January, really, that could potentially lead to a little bit more bullishness in the market. Just my opinion, no guarantees, obviously, but consider this. Usually right before fear events, you don't get a lot of rallying, right? But look at what we have here. Look what I wrote. Boring Fed meeting, quiet mode now, with less uncertainty, could create a near-term rally. Santa Claus, no guarantees, obviously. The next major catalysts are January 7th for the labor report, January 12th for the CPI report, December 14th for the expiration of PP, and the late January Q4 earnings. Q4 earnings, I think, are going to create some huge uncertainty and fear. So I think there's a greater chance that you potentially have a little bit of a micro rally now rather than after January CPI, because after January CPI, you're going to go into earnings. Then everybody's going to be focused on earnings. So I'm a little bit more short-term bullish right now since, like, we didn't get rug pulled. You know, Daddy Powell's at least somewhat happy with us. And, yeah, those are my thoughts. So anyway, thank you so much for watching as always. If you found this helpful, consider subscribing to the channel, share the video, invite your friends, check out my PP, the coupon code that is. It's pricing power is what it stands for, right? Check that out in the links down below, and we'll see you in the next one. Thank you so much. Goodbye and good luck.